Welcome back, everyone. We're about to embark on a deep dive into a fascinating piece of investing history. Warren Buffett's 1993 letter to Berkshire Hathaway shareholders.
It's like a time capsule filled with wisdom.
Absolutely. And we're going to crack it open and see what nuggets of gold we can find. Now, before we get into the specifics, can you give us a little context? What was the economic landscape like back in 93?
Well, picture this. Long-term interest rates were hovering around 6 to 7%. Pretty different from what we're seeing today, right?
Yeah, a lot higher. So with that in mind, what were some of the big themes that stood out to you in this letter?
Well, of course, Buffett kicks things off with Berkshire's performance, how their diverse businesses were faring. Then he dives into this really interesting acquisition of Dexter Shoe, which is a classic Buffett move.
Yeah, we'll definitely get to that. But first, I got to ask about this one number that jumped out at me, Berkshire's book value. It had grown from just $19 to over $800 in 29 years.
8,854 to be exact. That's a compounded annual growth rate of 23.3%.
It's mind-blowing. But Buffett, being Buffett, is quick to remind us that book value isn't everything. He says intrinsic value is what really matters.
Right, he always emphasizes that. So maybe we should take a moment to explain the difference.
Yeah, good idea. Break it down for us. What is intrinsic value, and why is it so important to Buffett?
Well, think of book value as like a snapshot of a company's assets and liabilities at a specific point in time. It's based on accounting principles, historical data.
Right, it's what's on the balance sheet.
Exactly.
Ugh.
Intrinsic value, on the other hand, is more about the future. It's the present value of all the cash a business can generate over its remaining life. It's a measure of true worth, what a business is actually capable of.
So he's looking beyond the numbers on the balance sheet and trying to understand the long-term earnings potential of the business.
Exactly. And for most companies, book value and intrinsic value can be very different.
But Berkshire is different, right?
Well, Buffett believes that due to Berkshire's unique structure and holdings, book value actually serves as a reasonable proxy for intrinsic value, at least in his view.
Okay, so in this case, we can look at that incredible book value growth and get a sense of the intrinsic value growth as well. But even with those stellar numbers, Buffett wasn't exactly celebrating.
He wasn't doing cartwheels, that's for sure. He describes the 14% growth in both book and intrinsic value as satisfactory but unexciting. And get this, he even mentions that the 39% surge in Berkshire's market price didn't faze him.
39%. I mean, that's huge. Most investors would be ecstatic.
Right, but that's classic Buffett. He's all about focusing on the long term and tuning out the short-term noise of the market. He sees those price fluctuations as distractions.
He uses the examples of Coca-Cola and Gillette, right? I vaguely remember reading something about that.
He does. Back in 1991, both Coke and Gillette saw their stock prices soar, even though their earnings hadn't really caught up. Buffett cautioned that this couldn't last forever.
So what happened? Did their prices come crashing down?
Not exactly.
Yeah.
From 1991 to 93, both companies grew their operating earnings by a healthy amount. Coke by 38%, Gillette by 37%.
That's pretty impressive.
It is. But during that same period, their stock prices only rose by 11% and 6%, respectively.
So their businesses were actually performing better than their stock prices reflected.
Exactly. And Buffett loves using these real-world examples to illustrate his point. He even goes back to Coke's IPO in 1919.
What happened there?
Well, Coke went public at $40 a share. Sounds great, right?
Yeah, not bad.
But then it plunged to $19.50 by the end of 1920.
Ouch! That's gotta hurt.
But here's the kicker. If you'd held on to that one share from 1919 and reinvested all the dividends,
You'd be rich.
by the end of 1993, that single share would have been worth over $2.1 million.
No way. So even though the price went down initially, the long-term value creation was incredible.
It's a perfect example of what Ben Graham, Buffett's mentor, said about the market. In the short run, it's a voting machine, but in the long run, it's a weighing machine.
I like that. Okay, so we've talked about Berkshire's overall performance and this long-term thinking, but let's shift gears for a bit and talk about the Dexter Shoe acquisition.
Ah, yes. Dexter Shoe. A classic Buffett story.
It's almost like he just stumbled upon this opportunity, right? He wasn't actively looking to get into the shoe business?
Well, not exactly. He already had some experience with the industry.
Oh, right. He had acquired H.H. Brown and Lowell shoe earlier.
Exactly. And those acquisitions have been incredibly successful, exceeding all expectations. That gave him confidence in the shoe business.
So he saw Dexter as a chance to double down on a winning strategy.
You could say that. Dexter was run by Harold Alfond and Peter Lunder, who were known for their exceptional management skills.
They had built a strong brand in a tough industry.
Right. And I'm sure Buffett loved the fact that Dexter was generating tons of cash. But there was another factor that sealed the deal: the tax advantages.
Ah, yes. Buffett always has an eye on the tax implications.
He structured the acquisition in a way that minimized the tax burden for both Berkshire and Dexter's previous owners.
Classic Buffett, finding those win-win scenarios. Okay, so we've talked about Berkshire's performance, the Dexter shoe acquisition, this idea of intrinsic value. But before we move on, I want to go back to something you mentioned earlier, look through earnings.
Oh yeah, look through earnings. That's a key concept for understanding how Buffett thinks about Berkshire.
So can you explain what that is? Why is it so important?
Look through. Earnings are a way for Buffett to look beyond just the reported operating profits on the income statement.
He's trying to get a more complete picture, right?
Exactly. He wants to understand the true earnings power of all the businesses Berkshire owns, both directly and indirectly. So, for example, let's say Berkshire owns a big chunk of Coca-Cola stock.
Okay, they do.
Coke earns a certain amount of profit every year, and some of that profit is reinvested back into their business.
Retained earnings.
Exactly. And even though Berkshire isn't receiving those retained earnings as dividends, they still contribute to the intrinsic value of Coke.
And therefore to the value of Berkshire's holdings.
Precisely. So Buffett includes those retained earnings in his look-through earnings calculation, even though they're not being paid out to Berkshire.
It's like he's looking through to the underlying earnings power of those investments.
That's a great way to put it, and gives him a more accurate picture of Berkshire's true earnings power. But there's a catch, of course.
There's always a catch, right?
If Berkshire actually received those retained earnings as dividends, they'd have to pay taxes on them.
Right. Uncle Sam always wants his cut.
So Buffett's look-through earnings calculation includes an estimated tax impact. He's trying to be realistic.
So it's not just blindly adding up all the retained earnings. He's factoring in the potential tax consequences as well.
Right. It's a more nuanced way of looking at earnings.
And it shows his long-term focus.
He's betting on the continued growth of those businesses, even if those earnings aren't realized right away.
This is really fascinating stuff. I'm starting to see how all these pieces fit together.
It's like putting together a puzzle, isn't it?
It is, and we're just getting started.
There's so much more to uncover.
Well, what's next on our agenda? Where do we go from here?
Next up, we'll explore Buffett's views on taxes and how minimizing your tax burden can make a huge difference in your long-term returns. He uses this hilarious anecdote from the Lil Abner comic strip to illustrate the point.
Okay, I'm definitely intrigued. This is turning out to be an even wilder ride than I expected.
Buckle up. It's about to get even more interesting.
Okay, so last time we were talking about minimizing your tax burden, and you mentioned this Little Abner comic strip. Now, I'm curious how those two things connect.
Well, Buffett's a big fan of using stories and analogies to explain complex ideas, and this one's a real gem. He brings in Lil Abner, this character from a comic strip he loves, to make a point about the impact of taxes on compounding. It's classic Buffett, making investing both relatable and entertaining.
So tell me, how does Little Abner fit into all of this? What's the story?
So, in the comic strip, Abner needs to become a millionaire to win the heart of his sweetheart, a passionate event climax.
Ah, the age-old tale. Boy meets girl, boy needs $1 million.
Right. But he gets this terrible advice from Old Man Mose, who's supposed to be like the wise man of Dogpatch.
Oh no, I have a feeling this isn't going to end well for Abner.
It doesn't. Mose tells him to just keep doubling his money. Start with a single silver dollar and double it 20 times and you'll be a millionaire.
Sounds easy enough, right?
Yeah, in theory. But Buffett points out the flaw in this plan.
No.
Taxes.
Ah, of course. In the real world, you got to factor in Uncle Sam.
Exactly. Buffett explains that if Abner had to pay a 35% tax on each of those doubles, like how Berkshire pays taxes on capital gains, he would end up with a measly $22,370 after 20 years.
So much for marrying a passionata.
Right. Poor Abner would still be broke and heartbroken. But then Buffett offers a different approach. What if, instead of chasing quick doubles and paying taxes along the way, Abner had just made a single investment and held it until it had doubled 27.5 times?
Okay, so a much longer time horizon, but fewer taxes in the meantime.
Exactly. And the difference is astounding. After 27.5 years, Abner would have had over $200 million before taxes. And even after paying taxes in that final year, he'd still be left with around $130 million.
Talk about a life changer.
Right. Appassionato wouldn't even hesitate.
She'd probably build him a mansion in Dogpatch.
Probably. So the takeaway here is that delaying taxes and letting your investments compound over the long term can create far more wealth then a series of short-term gains that trigger taxes along the way.
That's a powerful lesson. And it really highlights the beauty of Buffett's buy and hold philosophy.
Find great companies, buy their stock, and let them compound their earnings over decades.
Pay the taxes when you eventually sell, but in the meantime, let those returns snowball.
Exactly. Now, how does all this tie back to the economic landscape of 1993? Remember those high interest rates we talked about?
Yeah, 6 to 7%.
That made the insurance business particularly attractive. And as you know, insurance has always been a core part of Berkshire's success.
Right. Buffett loves insurance. He often calls it the engine that powers Berkshire's investment machine.
He does. But in this letter, he gets into some of the nuances of the industry, and he explains why traditional metrics like the combined ratio aren't as reliable as they used to be.
What was he getting at there? Can you elaborate on that a bit?
He was essentially highlighting how declining interest rates affect the value of float.
Float, right. Remind me what that is again.
Float is the money insurers collect in premiums up front, but they don't have to pay it out in claims until later. It's essentially free money they can use to invest.
So it's like this giant pool of cash they can use to generate returns.
Exactly. But when interest rates fall, those returns on float shrink.
Right, that makes sense.
So insurers can't rely as heavily on high returns from float when rates are low. They also need to be profitable on the underwriting side, meaning they need to collect more in premiums than they pay out in claims.
And this is where Berkshire shines, right?
Absolutely. In 1993, they had a staggering $2.6 billion of float at a negative cost.
Negative cost. That means they were actually making money on the underwriting side, on top of the returns they were generating by investing the float.
That's the beauty of Berkshire's model. But of course, even Buffett, with his incredible track record, acknowledges that the insurance business isn't without its risks. He specifically talks about the super cat market.
Super cat, that sounds ominous.
It refers to super catastrophe insurance, things like hurricanes, earthquakes, major disasters that can lead to massive insurance payouts.
So it's a high-risk, high-reward kind of game.
You could say that. Buffett uses this analogy of betting against a rare event that happens 25 times a century. You might win many years in a row, but eventually that event's going to catch up to you.
It's like playing Russian roulette, but with hurricanes and earthquakes.
Sort of. The point is, you can't get complacent. In the supercat business, when a loss comes, it's likely to be huge.
So you need a big margin of safety and a strong stomach.
Exactly. And that's where Berkshire's huge capital reserves and their underwriting expertise come in. They got the financial strength and the know-how to weather those storms, which is why Buffett remains cautiously optimistic about the supercat market.
It's a reminder that even the best investors can't predict everything. There's always an element of uncertainty.
Absolutely. And speaking of uncertainty, let's move on to another key part of Berkshire's portfolio, their common stock investments.
Okay, this is where it gets really interesting for me. I'm always curious to see what companies Buffett's betting on. What did his portfolio look like in 1993?
Well, he describes it as a collection of durably wonderful businesses. We're talking about companies like Coca-Cola, Gillette, and Capital Cities ABC.
Blue chip companies with strong brands and consistent earnings.
Exactly. The types of businesses he loves. And he's not afraid to concentrate his holdings in a few key companies. He's not a fan of spreading himself too thin.
Right. He's famously said that diversification is a protection against ignorance. It makes sense if you don't know what you're doing.
He believes that too much diversification can actually hurt your returns and increase your risk, especially if you're investing in businesses you don't fully understand. He'd rather focus on a handful of great companies that he knows inside and out.
And that's where his concept of Mr. Market comes in, right? That manic depressive character who's always offering to buy or sell stocks at these fluctuating prices.
Exactly. Buffett sees those fluctuations as opportunities, not threats.
When Mr. Market is feeling down, he's ready to sell you pieces of great businesses at a discount.
But you have to be patient and disciplined to wait for those moments.
And you have to be able to recognize the true value of what's being offered.
Right. It's about separating the noise of the market from the underlying fundamentals of the business.
So how do you know when a price is truly a bargain? How does Buffett define value?
Well, this is where he challenges the traditional academic view of risk, which often focuses on a stock's volatility.
Volatility.
Yeah, how much the price jumps around, They measure it with this thing called beta.
Oh yeah, beta. I've always found that a bit confusing.
Buffett thinks it's flawed. He argues that just looking at price fluctuations misses the big picture. For example, the traditional view might say that a stock that has dropped sharply in price is suddenly riskier.
Which seems counterintuitive, right?
Totally. Wouldn't it make more sense to see that as an opportunity to buy a great business at a discount?
Yeah, that seems more logical.
Exactly. Buffett defines risk as the possibility of losing purchasing power over your investment horizon. He focuses on things like the strength of the business, the quality of management, and the purchase price relative to intrinsic value.
So it's about finding companies that can generate consistent returns over time, regardless of those short-term market swings.
Exactly. Investing is not just about picking stocks, it's about owning businesses.
You need to understand how those businesses work, what their competitive advantages are, and how they're likely to perform in the future.
Right. That's the key. And speaking of thinking about the future, let's touch on a topic that's always on the minds of Berkshire shareholders. Succession planning.
Yeah, what happens to Berkshire after Buffett's gone? It's the elephant in the room.
It is a big question, and Buffett doesn't shy away from it in this letter. He outlines his plans for the company's governance and the role his family will play in the future. It's a fascinating glimpse into how he's thinking about ensuring Berkshire's continued success.
Okay, this is where it gets really interesting. Give us the inside scoop. What's the plan?
So you want the inside scoop on the succession plan? Well, to really understand it, we need to unpack the different models of corporate governance that Buffett lays out in this letter.
Yeah, let's do that. I think it'll help connect the dots.
He's got these three models. The first one is the most common: a corporation without a controlling shareholder. Think of your typical publicly traded company with a broad shareholder base.
Okay, got it. So in that scenario, what's the board's role?
Buffett believes that in those situations, directors should act as if they're representing a single owner whose interests they need to protect. Someone who's not actively involved in the day-to-day, but cares deeply about the long-term success of the company.
So make sure management isn't just serving themselves, but they're actually acting in the best interest of all shareholders.
Right. Now, the second model, that's where Berkshire was in 1993. This is when the controlling owner is also the manager.
So in this case, the board's role is a bit different, right?
Yeah, it's more about advising and challenging the owner-manager than acting as a traditional check on management. Think of it like a sounding board.
So for Berkshire, that meant the board couldn't really force Buffett to do anything he didn't want to do.
Exactly. They were there to offer guidance and support, but ultimately, he was calling the shots.
He even admits that if an owner-manager is making bad decisions, there's not much a board can do except voice their concerns or just resign.
True. It can be a tricky situation. But then he gets to the third model, and this is where it gets really interesting. This is where you have a controlling owner who's not actually involved in management.
So like a family-owned business where the founder has passed on control to their heirs who aren't running the company.
That's a great example. And in this model, Buffett argues that outside directors actually have more power.
More power? That seems kind of counterintuitive. Why is that?
Because they can go directly to the controlling owner, who presumably wants the company to succeed, and voice their concerns about management. If the owner is persuaded, they can actually take action.
So it's like a back channel for feedback and accountability. The board can bypass management if they need to.
It's a pretty clever system.
Yeah.
Right? And Buffett thinks that over the long run, this third model can be the most effective way to make sure the company has high-quality leadership.
And he's pretty clear that this is the model he envisions for Berkshire, right?
Yeah, he says that when his stock passes on to his wife, Susie, or his foundation, Berkshire will transition to this third model. He wants to ensure that the company's in good hands even after he's gone.
And he's already starting to lay the groundwork, right? Susie was on the board, and his son, Howard, joined in '93.
Exactly. He's setting the stage for a smooth transition. It's really impressive how he thinks about every aspect of the business, even decades into the future.
He's the ultimate long-term thinker. Now, before we wrap up this deep dive, there's one more unique thing about Berkshire that we have to talk about. The Shareholder Designated Contributions Program.
Ah, yes. This program really gets to the heart of Buffett's philosophy on ownership. Instead of having the CEO or the board decide how to allocate charitable donations, he lets the shareholders choose.
It's so unique. I haven't heard of any other company that does this. How does it work?
It's pretty simple. Each year, shareholders get to direct a portion of Berkshire's charitable giving to the organizations that they care about.
It's like a democratic approach to philanthropy.
Exactly. It's the shareholders' money, so they should get to decide where it goes. And the impact is incredible. In 1993, over 97% of eligible shares participated, with over $9 million going to over 3,000 different charities.
It's amazing to see the range of causes that Berkshire shareholders support, everything from education to healthcare to arts and culture.
And Buffett points out that shareholders even gave to both pro-choice and pro-life organizations, highlighting the program's respect for different points of view.
So it's not about pushing one agenda or another. It's about empowering shareholders to make a difference in the areas that they feel are most important.
Right. It's a powerful example of shareholder engagement. And it really shows that Buffett believes that Berkshire's money ultimately belongs to the owners.
And he backs that up with action. Remember, he even increased the amount shareholders could designate that year.
From $8 to $10 per share. He's always looking for ways to make the program even better.
It's really inspiring. You know, as we've been going through this letter, I'm just struck by how much wisdom is packed into these pages.
It's amazing how relevant his insights are, even decades later.
His principles of long-term thinking, value investing, building a durable business, it's all timeless stuff.
And beyond just the investing lessons, there are so many valuable life lessons, too. His emphasis on integrity, humility, knowing your limitations, that's something we can all apply to our lives.
It's not just about making money, it's about living a good life. Well, that wraps up our deep dive into Warren Buffett's 1993 shareholder letter. What a journey.
I always learn something new every time I read it.
If you're interested in learning more about Buffett and his approach to investing, I highly recommend checking out his other shareholder letters. They're all available online for free.
They're a treasure trove of wisdom. And the best way to learn from Buffett is to put his principles into practice. Think long-term, focus on value, and always remember to stay within your circle of competence.
Wise words. Until next time, happy investing.